Hello, everybody. Welcome to our presentation on Is Your Employer-Owned Life Insurance Taxable? Internal Revenue Code Section 101J Compliance, presented by the ASA Group. We're very happy that everyone was able to join us this morning, and we're looking forward to what we believe is a very valuable presentation for you and for your business clients. So with that said, we're going to get going. We once again thank you for joining us. We're going to be together for about 30 minutes this morning.
First thing is let's talk about what parts of the code we are talking about. In Section 863 is the Pension Protection Act of 2006. So this has been around for a long time. It's just been overlooked. Part of the Pension Protection Act was Section 101J, which is called the COLI Best Practices Act. Now, some of you that have been in the industry for a little while know COLI as a form of insurance, an institutional offering that has high early cash values, no surrender charges, and it's primarily what corporations and businesses might buy because they need to see something that has a high early cash value for accounting purposes on their books, on their balance sheet. For the purposes of our conversation today, COLI means a form of ownership, though. It could be an institutional COLI product, but it is any type of life insurance policy that is owned by an employer. So it could be term insurance, whole life, universal life, variable life, and COLI. So it's very broad in its application. The core, and you'll hear me say this probably 20 times, of the COLI Best Practices Act is what are called notice and consent, and then exceptions. We'll dig into that in a little bit. In addition, there are filing requirements that are for compliance purposes, and that is in Section 6039 of the code. And there's a Form 8925 from the IRS that has to be filed yearly with the tax return. That essentially provides information to the IRS about employer-owned policies. If you want to read, and I would strongly encourage you to read Notice 2009-48, send a note to us here at the ASA Group if you want us to send you a copy of it. And that is kind of the definitive IRS guidance on 101J compliance. It's an easy read. It's only a couple of pages. So I would highly recommend you read it if you want to, just kind of see what the IRS thinks about it. Okay, we're going to have a little fun here. For the first person that sends a note in our chat box, who this person is and what movie they are from, Beth is going to put together some tchotchkes and send those out to you. It's just, tchotchkes are just little fun things. Maybe it's a phone charger or just little things that carriers put together for us. So as some of you know, the man in the picture is named Carl from the movie The Breakfast Club. And Carl was the janitor who knew everything that was going on in the school. Well, what does Carl have to do with 101J compliance? What happened primarily, Winn-Dixie was the first, I guess, really big violator of this. They realized that it was very profitable to buy insurance on everybody at their company. And collecting those death benefits is very profitable, looks good on the balance sheet. And what would happen, though, is when Winn-Dixie, let's just say, collected the life insurance on Carl when Carl passed away, Carl's family might have been living hand to mouth because Carl was a janitor and probably wasn't well paid. And Carl's family would not receive any of those death proceeds. So there was some litigation and Congress got involved, and ultimately the decision was made that a major corporation, or any business for that matter, does not have an insurable interest in the life of Carl. They do on their executives and owners if they're active in the company, but they don't on Carl. So they enacted a very broad piece of legislation called the COLI Best Practices Act to try to prohibit or discourage companies from buying insurance on folks like Carl. So that's how we got here. But what happened was Congress passed a very, very broad piece of legislation. So let's dig in. The key part of the COLI Best Practices Act is notice and consent. And you have to cover specific categories of covered employees for the insurance not to be taxable. So the IRS takes the position that all insurance at the corporate level or the employer level is taxable unless you have notice and consent and you cover specific categories of covered employees. Violating 101J results in income taxable death benefit in excess of the premium paid. The Best Practices Act applies to all policies owned after August 17, 2016. So right away, write that down. Start looking at all of your talking to all your business clients that own life insurance and find out if they bought any insurance after August the 17th, 2006. And if so, you need to do a 101J audit. Now, there is a note down there. There is a 1035 exception for policies issued after August 18th, unless a material change. What I mean by that is, let's say you bought a policy on Mike the Key Person in 2002 for $1 million. And then in 2012, you 1035 exchanged that policy into a new policy worth $1 million. That new policy would be grandfathered and would not be subject to 101J compliance. However, if as part of the 1035, you decided that now Mike needs $2 million of insurance, that new sale would be subject to 101J compliance because taking a policy from $1 million to $2 million is a material change and you would have to comply. Okay? All right, so what does this notice and consent form look like? Well, the IRS does not say what it needs to look like. They only tell you what needs to be part of it. So in the one we have, the sample, essentially it says you're notified that ABC Incorporated is buying a policy on your life not to exceed, let's say, $5 million. So they say, hey, Mike, we're going to buy $1 million policy on you. Down the road, we're probably going to buy more. We think we might need as much as $5 million on your life. You'd have to put the total amount that they think they might need on you. And that we're going to be the beneficiary of that policy. The company is, and we're going to keep that policy even if you leave the company. And then you're going to consent to two things. Number one, okay, I understand that you're going to buy a policy on my life. And I also understand that when I leave, you can keep it. And that's what you're going to consent to. So it's notice and then your consent. What's the second half? The second half are 6039 filing requirements. So there's some annual reporting, Form 8925. So if you're prospecting, you need to speak to a business owner or their CFO or their accountant. If you want to prospect accounting firms and say, if it's the business owner, say, hey, who does the Form 8925 filings for your company? Well, I don't know what you're talking about. Well, do you guys own any life insurance on your employees? Well, sure we do. We've got some policies on me and John and whoever. Okay, then you should be filing a Form 8925 every year. Who does that? Well, we don't file Form 8925s. All right, you may have some issues that could create taxation on those death proceeds. Why don't you let me do a 101J audit for you? Or go to a CPA firm and say, hey, I wanted to ask you guys, who here in the firm does the 8925 filings for your business clients? Well, we don't know what you're talking about. Well, so what we do is turn this into a CPE opportunity, or not, but we can deliver it from CPE perspective, and teach CPA firms so that hopefully they look at you as the as a source of confidence, somebody that they can go to with insurance issues for their clients. I like the Form 8925 just because it's I think it's a probably a really good audit trigger. So let's take a look at this. Line 1 is, how many employees do you have at the end of the tax year? Let's say it's 100. Next line, enter the number of employees on line 1 who you had insurance on at the end of the tax year and that you bought after August 17, 2006. So let's say the number is 5. The next line is, okay, we want to know how many life insurance policies you have in force on that group of employees. Let's say the number's 5. And here's my favorite question. Do you have a valid notice and consent for each employee included on line 2? Let's say you don't know what this form means and you say no. And if you said no, enter the number of employees on line 2 for whom the policyholder does not have a valid notice and consent. Now, that's entertaining to me because if I was the tax advisor for this business owner, I would never submit this form that way. If that truly was the way it should be answered, I would address the problem and fix it. And I would make sure that I cured any of their notice and consent issues, which we'll talk about in a little bit, before I filed the form. Because the form is, if you fill out this form, you're just begging the IRS to come and audit you when somebody passes away at your company. So let's look at a little application of 101J, some real world applications. Owned by a person, that essentially is a very broad term. Engaged in a trade or business, it essentially means the company. By the way, it can be any kind of company. It can be a corporation, a sub S, a C, an LLC, a partnership. It could be a sole proprietorship if they owned insurance on an employee. But let's say if the insurance is owned at the entity level, did 101J apply? Absolutely. If you buy insurance on somebody at your business, 101J applies. What about owned by a shareholder? No 101J. Well, let's think through that. We probably all own stock in a public company. If you do, or even in a private company, if you do, you don't have to comply with 101J. But if you own stock in the company, you're an owner and you are an active participant in that company, that's a different deal. And we'll talk about that in a little bit. What if it's owned by the qualified plan? So maybe you've got some insurance inside of a cash balance plan or a split funded defined benefit plan. You don't have to comply with 101J. What about a rabbi trust? So if you do deferred compensation planning, some companies will set up a trust inside the company to own the insurance to fund executive fringe benefits. They do that to protect those policies from the ownership of the company and the management from using those cash values for everyday operating expenses. A rabbi trust does not protect the policies in the event of corporate bankruptcy, but it does prevent them from management just using the cash. But 101J applies if you buy insurance to fund CERT plans and deferred comp plans and split dollar plans, if you see down below. So let's say you have in a split dollar endorsement. Endorsement split dollar can be either individually owned or corporate owned. 101J applies. Collateral assignment split dollar, same thing. So if you do any kind of split dollar, think about 101J compliance. When in doubt, comply. It's a very broad statute. So what does notice and consent mean? In place before the issued ladder of. So what this means is, let's say the application date. Normally at the ASA group, we include the notice and consent. We include the information on notice and consent when the application is taken. That's the safest thing to do. The effective date of the coverage sometimes is, most of the time after the application date. and the formal issuing of the coverage is also. So safest thing to do is when you take the application, fill out 101J notice and consent form. And however, there are later dates for when it needs to be done by. The responsibility is on the employer. It's not on you. It's not on the insurance company. It's not on their attorney or CPA. Now, the employer is probably the least informed person on 101J. What we do at ASA is when an application comes in and it's owned by a company, we will automatically send a kit, a 101J kit, out to the producer to remind them that they probably need to get 101J. The carriers don't see it as their responsibility. It's a liability issue for them, I'm thinking. Some carriers provide sample notice and consent forms and some do not. But the carriers do not want that form. That form needs to be kept at the business when they get audited. It's got to list relevant policy information, including amount of coverage. We've already been through that. So how about exceptions? So you got to follow notice and consent, and you've got to comply with an exception. So you've got to insure an officer, director, or highly compensated employee. You have to pay the death benefit to the insured's family. So let's just say it could be let's say an endorsement split dollar would be that. Used to purchase ownership interest in an entity. So let's say it's an entity buy-sell agreement and the insurance is owned at the corporate level. Employed within 12 months of death. So that is that's kind of the requirement that allows you to still insure people like Carl. So if you had Carl sign a notice and consent, and you insured Carl, but then Carl left the business and Carl was gone more than 12 months, those death benefits would be taxable. And the only way to cure that would be to bonus that policy to Carl. So if you don't insure somebody who's in one of those three categories, and they leave the business, then that policy will be taxable. Now, if they die within 12 months, I mean, if they were employed within 12 months of death, then you're fine. But I mean, that's just a timing issue you can't control. Okay. Let's talk about cures. And this is where I've commented to lots and lots of people that you would think that somebody in the insurance industry helped write the act and write the cures to 101J. So before we look at any policy, we recommend a thorough policy review. And I think that's important because business-owned insurance needs to be reviewed no matter when it was purchased. 101J is just a wrinkle after 2006. But if you find policies that were issued in 2000, so let's think about this. You've got sustained low interest rate environments for a long period of time. You've had a couple of market ups and downs that can affect variable life policies. Those sustained interest rates affect whole life contracts. They affect universal life contracts. You've got cost of insurance issues out there. So it doesn't matter when the policy was purchased, you need to do a policy review. So let's say you got a policy with a problem. Well, we talked about this cure earlier. Let's say you've got a policy. It was bought after 06. It does not have notice and consent. It's out of compliance. Let's move that into a new policy with a material change. So let's take that $1 million policy bought in 2008 and let's 1035 it into a new policy, and let's make sure the death benefit is more than $1 million. So let's say we did a new $1.5 million policy. The IRS doesn't say how much the increase needs to be. It just says it needs to be a material change. What about buying a new policy and surrendering the old one? Absolutely. So let's say you've got a term policy there. They still want to keep term. And you say, all right, well, let's just rewrite this $1 million of term. And once we get it issued, we can discontinue the old policy. All right, well, what about a term conversion? I have had legal departments at several major insurance companies provide different answers on this. I think converting from a term to a permanent policy is a material change, but some legal departments are hinging material change on increases in death benefit. So it's a gray area. It is not guaranteed that if you convert $1 million term to $1 million guaranteed UL, that is an exception. That would be a cure. So the only real guaranteed cure is rewrite the term or convert it and do a higher death benefit on the permanent policy. Or just surrender the term, buy a permanent policy, and don't convert the old term. That way there's no connection between the old policy and the new policy. And then obviously on all of these cures, you're doing new 101J compliance on the new policy. Don't forget, if it's split dollar, you can terminate the split dollar plan if you want to, but a lot of times those trigger compensation issues. And you know what? You're doing split dollar in the first place to fund a policy. So if you terminate the split dollar, a lot of times you got to figure out how you're going to keep paying for that contract. So how about some case examples? We've got 10 minutes left or so. Let's say you have multiple businesses and a common owner and a different co-owner for each business. So say we've got 5 businesses. One person owns half of all of them, and then he's got 5 different owners, co-owners in each business. And the co-owner in business 5 passes away. There was no notice and consent. Policy was bought in 2010. You're in trouble there. If you get audited, that death benefit's going to be taxable. All the other businesses have term on the owners, and they have no written buy-sell agreement. So the solution here is you've got to rewrite all of this term insurance, and you have to, if you rewrite all the term insurance with new notice and consent, and you're doing it on someone who's in the exempt class, you don't need to worry about a buy-sell. But if you're buying the term to do the buy-sell, then obviously you should go ahead and get that buy-sell executed. What if you obtain the notice and consent by the close of the tax year of the policy purchase? So the policy's issued, you didn't get it done in time, but you figure it out before you got to close your tax year, and then you do it. Well, maybe not. The IRS has said if you have written procedures for obtaining notice and consent, and this was simply an oversight, then there is commentary that they would allow that. There's also commentary that if there are no written procedures, which I think in most cases there wouldn't be, and you didn't get the notice and consent because you just didn't know, it's not good enough because you didn't have it done before the effective date of the policy. So the rules are really, really strict. Let's say you had no notice and consent, but you did a buy-sell agreement prior to policy issue. I don't mean years prior. I mean in the same year you're saying we're going to get a buy-sell and we're buying insurance to fund it. There is commentary that the execution of a buy-sell agreement at the same time you're buying the insurance is sufficient notice and consent, because those policies are normally going to be referred to in that buy-sell agreement in some kind of an appendix. What if you don't have notice and consent and you figure it out 5 years later, but you go ahead and amend your tax returns back to the insurance purchase and you file the 8925s? Remember, on the 8925s, it asks if you got notice and consent. And if you don't, you're in trouble. If you don't remember anything else about the COLI Best Practices Act, the only thing you should remember is it all starts with notice and consent. And if you don't have that, then you're in trouble. You need to pursue a cure. And the cure is normally replacing and rewriting the insurance that is non-compliant. So with that said, I want to open it up to questions. Now, what we want you to do is send your questions in the form of the chat, and then we're gonna answer those questions to the group as a whole via email. So we want to thank everybody for joining us today. We certainly appreciated the opportunity to share this with you. I think this is a great opportunity to prospect business owners and CPAs, because they've all got business owners as well, and then to position yourself as a good resource and then you can always lean on us. We will be sending out a 101J compliance questionnaire. So it's a really good, easy questionnaire that you can use when you're sitting in front of a business owner and you just say, well, I'll tell you what, let me just ask you some questions. And then based on your answers, that's going to tell us whether there's some things we need to dig into. So we'll be sending that 101J questionnaire as well. Hope everybody has a great day, and we look forward to being with you on the next webinar. Thanks so much. Bye.